William Lee, Chief Economist at Milken Institute. Thank you so much for being here. Today is the day, Fed Day. No chances of a hike, right? I don't know. You tell me. I mean, there was always a chance. No chance of a cut, probably. Your thoughts on what the Fed may be thinking here today and what we may hear in the press conference?
What we should be listening for are clues as to what the Fed is going to be doing, because we know for sure, almost for sure, that the Fed's not going to do anything today. But the information is really going to be critical. How does the Fed assess the economy? Are we going to get rate cuts coming sooner or later? And I think right now the markets are all betting that it's going to be somewhere around March. Almost everyone you talk to is saying March is way too soon. So where's the disconnect? And I think that's where we have to think about what impact will this have on our portfolios. I think our viewers out there are much more concerned about what do I do with my portfolio? And I think right now the question is, if the rate cuts turn out to be what I call bad rate cuts, the economy is going to crash, and the Fed has got to do some real defensive stuff to try to support the economy and cut like crazy because GDP starts to fall off the cliff and unemployment rate starts to rise. Those are bad rate cuts. Oil prices go up and we get stagflation. Those are bad rate cuts. But there are some good rate cuts. If inflation really does start to decline faster than the Fed thinks, real interest rates, as we talked about before, are really, really high right now. And the Fed has to get real interest rates down to somewhere in the 3/4 range. Right now, they're at 1 3/4, almost 2%. So there's a lot of room for the Fed to cut. The question is, how fast will they have to cut? And that will have great impact on our portfolios. And right now, the likelihood is they're going to be good rate cuts because inflation is coming down and the prospect of a economy crashing is really quite low.
Right. Those big recession fears, the big worries of the hard landing seem to have dissipated. And there's really a feeling from a lot of the folks I speak to, Bill, about that he won't necessarily show his whole hand. For example, he may say higher for longer for some time instead of saying, oh, yes, we plan to cut, 4 times, 5 times, 6 times. I mean, why even bother trying to allude to that? It's better to sort of stay on the Fed speak, right?
Absolutely. In fact, I've been very critical of the Fed for doing exactly that, because Powell has this sense of I'm going to bob and weave and I'm going to be a real boxer and not let the markets catch me. That's not the right way for a Fed chairman to behave. He should have been telling us, look, when inflation starts to come down and gets close to 2%, we're going to be cutting. The question is, we need to be convinced that it's near 2% and it's going to stay at 2%. We're not going to get surprised again. That kind of guidance is something that the Fed used to do before with forward guidance. He got burned by that, and I think he says, forget it. I'm going to be bobbing and weaving. Bobbing and weaving means the bond market volatility is up. Equity markets are uncertain about what to do. And our audience out there is saying, my God, what is the Fed up to? And all this discussion of what the Fed is up to, he could really calm people down by saying, look, we will be cutting. The question is, are we convinced inflation is going to stay at 2%? And we'll tell you as we come along how convinced we are. They do that, and we're going to solve a lot of problems.
Yeah, you have real long-term interest rates. That's something you're watching closely. Tell me a little bit about that and why that's an important distinction.
The cost of capital deals with long-term rates. When firms go out to borrow, it's somewhere in the 5 to 7 year range. The 10-year is always a good benchmark for where these long-term rates are. And if you look at these long-term rates, they've come down quite a lot, but the inflation-adjusted interest rates take away the expected rate of inflation over the next 5 years, and you find that the real interest rate is at 1 3/4. That's very high compared to the historical norm of somewhere around 1/2 to 3/4, so maybe 1%. Those are levels that will sustain growth at a moderate level and at a really a good level, a healthy level for the United States. Right now, we're way too high. So the Fed knows that, and they know that we have to bring rates down and before the economy starts to recede. Right now, we just got numbers about industrial production. The manufacturing sector is really doing very badly. It's contracting. Now, if that spreads to the rest of the economy, then we get bad rate cuts. The likelihood of that happening is very low. Look, GDP now, forecast by the Atlanta Fed, is at 3% for the first quarter. So the economy is chugging along pretty with a pretty good head of steam. And that's what gets the Fed concerned, that because the economy is so strong, inflation may not come down as fast as we had hoped to get those good rate cuts.
Yeah. Yeah. On your notes, you talk about some of the geopolitical risks.
Yeah.
You talked about the election in Taiwan. You talked about the Red Sea. I mean, of course, there's a lot going on abroad. Those two stood out to you. Why?
Well, last time I was on with you, I said inside baseball discussion is always about the real rate. And the question is, what could knock the real rate off course? And right now, the domestic economy looks pretty good, but these geopolitical risks are quite serious. Keep in mind that the reason why we got into such trouble is because our supply chains got disrupted by COVID. What's happening in the Red Sea right now? Well, that disruption is starting to get much more serious, especially since our U.S. troops are starting to get hit. And if we find that supply chains get disrupted again, and more importantly, these regional conflicts become much more widespread. If Ukraine, the Gaza, which were really considered by the markets as contained and not having an impact on oil prices and other systemic influences, if the Red Sea is a wild card because that could really put supply chains at risk. The election in Taiwan, people have completely ignored, and they thought that well maybe China is okay with that because the Kuomintang has got a majority in the legislature. Remember, our supply chain of semiconductors comes directly out of Taiwan. Full stop. That's the main supplier of our advanced semiconductors. We disrupt that, and we get some serious problems with our economy. So these are things I think the markets have not priced in adequately and have really not paid a lot of attention to. It's not a high risk right now, but keep an eye on it because those are the scenarios that would add to the risk of our domestic scenarios and cause the Fed to pause in its rate cuts.
Billy, always great to have you on the show of the Milken Institute. Thank you so much, and on such a key day today.
Thanks for
I
having me.
liked our real discussion as well. Thank you.